What's up, everybody? Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday, everybody. In the face of the pandemic and the Evergrande Housing Crisis, it is increasingly certain that Beijing will indeed turn to its old playbook of credit-funded infrastructure spending to maintain politically set growth rates and targets, a move which will yet again kick the can of much-needed economic rebalancing down the road, forcing private sector property developers to deleverage, only to make state-owned enterprises with state loans and unproductive infrastructure construction pick up the slack, is only moving the trouble around. At the system-wide level, it doesn't fix the underlying issues of moral hazard and unsustainable growth levels. In less than a month, development goals and government priorities for the year will be announced at the annual session of the National People's Congress, NPC. However, we can get a sense of concrete policy regarding spending by looking at the plans released at the provincial level. As of this week, 31 provincial level governments on the mainland have announced their growth targets and policy goals for the new year. Indeed, we covered a few days ago that the majority of local governments set lower goals for 2022 than they did for last year, with half expecting GDP to grow at the same level or slower. Analysts with Chinese financial media outlet Caixin observe that of the around 20 provincial level regions that have announced growth targets for fixed asset investment, which includes government-driven infrastructure spending, almost all set targets higher than their GDP growth targets. China finance expert at Peking University, Michael Pettis, responded to this analysis today, expressing that this shouldn't be a surprise at all. Last year was the only year in which a surge in consumption, mainly a reversal of the sharp contraction of the previous year, was likely to lead GDP growth, and this was reinforced by soaring exports and strong private sector investment. This is very much in line with what we observed again and again on China Update last year. As a result, Beijing was able to force local governments to cut back on infrastructure spending in 2021, even as it clamped down on the property sector. Quote, "This is something it had been eager to do for years, but couldn't as long as it set high GDP growth targets, but that was clearly a COVID-related one-off. This year, especially given the sluggish recovery of the property sector, there is no way local governments could achieve their growth targets without even faster growth in fixed asset investment." End quote. What he is saying here, and what we've been saying last year, is that it no longer has this one-off opportunity to see natural growth driven by consumption being faster than the politically set targets. This year, the natural growth is too weak, and so the government must turn back to artificially high rates, which means credit poured into unproductive investment. Pettis and others convincingly argue that this is why local governments expect fixed asset investment growth to lead GDP growth again. This also means that China must again see rapid growth in its debt burden, which is already at historic and comparatively high levels internationally. Quote, "It's no coincidence that this week the National Institute for Finance and Development said it expected China's debt to GDP ratio in 2022 to rise by 4 to 5 percentage points." End quote. Liaoning, whose fixed asset investment grew 2.6% in 2021, said it will, quote, "do anything possible to expand effective investment." End quote. It aims to increase fixed asset investment by around 10% this year through quote-unquote quality projects, including nuclear power plants, high-speed railways, and airport projects. Note that none of these are new high-tech productive projects. These are the same projects that have been built for decades now, and which analysts increasingly argue no longer provide productivity gains and simply add to the debt burden. Analysts with Yuekai Securities Co. wrote in a research note this week that China may set a national growth target of between 5 to 5.5% this year. It is my view that failure to make 5.5% would hurt market expectations across the economy, as economic actors, whether consumers, producers, or investors, would see how difficult it is becoming for Beijing to maintain decent and no longer even that particularly high growth rates. Next up, a few developments with US-China relations. By the way, guys, if you're enjoying the content, don't forget to hit that like button. It's a huge help for a small channel. And if you're watching this for the first time and you enjoy the content, maybe consider subscribing. Okay, the United States Trade Representative Office published its annual report on China's World Trade Organization, WTO, compliance this week. This coming hot off the heels of a very disappointing result of the Phase 1 trade agreement. Of course, we covered this last week. China dramatically underperformed in its commitments under the Trump-era trade agreement, and the ball is still very much in the Biden administration's court as to how the US responds. Now, turning back to the USTR report, Ambassador Catherine Tai expressed that China had not moved to embrace the market-oriented principles on which the WTO and its rules are based, despite representations that it made when it joined 20 years ago. Quote, China has instead retained and expanded its state-led, non-market approach to the economy and trade. It is clear that in pursuing that approach, China's policies and practices challenge the premise of the WTO's rules and cause serious harm to workers and businesses around the world, particularly in industries targeted by China's industrial plans. End quote. Meanwhile, in a move which represents a challenge to the so-called panda diplomacy introduced over 50 years ago, a US congresswoman recently proposed a bill to bar giant panda cubs born in the United States from being returned to China. The Republican congresswoman argues that pandas should not be used as window dressing and that Beijing uses the animals to quote-unquote soften its image. State media has criticized the move, unsurprisingly. I don't know how likely it is to pass, but it is yet another sign of the hardening attitude in Washington towards Beijing. And last up, we need to touch on several important economic, financial, energy, and technology developments in the People's Republic of China. Chinese financial media outlet Caixin published a great report today breaking down the investment decisions of the world's top capitalist institutions towards Chinese companies. Now, quoting the report, regulatory findings with the US Securities and Exchange Commission, the SEC, covering the fourth quarter of 2021 reveal that Goldman Sachs Group, Morgan Stanley, and JP Morgan Chase & Co. all trimmed their holdings in e-commerce heavyweight Alibaba Group Holdings, Morgan Stanley and JP Morgan, along with BlackRock Inc. and Cathie Wood's ARK Investment Management, also offloaded shares in Baidu Inc., another Chinese technology company. Uncertainties persist about the outlook for the battered technology and consumer e-commerce sectors after last year's regulatory storm. Those holding Chinese technology company stocks know painfully well how they were smashed last year. Speaking of international investment, analysts with the same outlet also report today that China has okayed a $3.3 billion Audi FAW electric vehicle facility in the country. Chinese state-owned car maker FAW Group Co. Limited and German firm Volkswagen received the regulatory approval to build the EV plant in northeast China, also known as Manchuria in English. Construction will begin in April of this year and is set to be completed by late 2024. This is not the first international company to have to work with a local firm in order to open car manufacturing operations in the People's Republic of China. It appears that China's crude oil imports and reliance on foreign oil declined for the first time in 2 decades, a development that energy analysts put down to rising global petroleum prices, expanding domestic production, and some domestic analysts argue strengthened supervision of local refineries. According to the China Petroleum and Chemical Industrial Federation, China's annual crude oil imports slid 5.4% in 2021. This is the first drop since 2001. Domestic commentators have also celebrated this as the first decline in Chinese reliance on foreign oil, that is, the proportion of net crude oil imports relative to total oil consumption in 20 years. It's down 1.6%. However, this is a drop in the bucket, or perhaps barrel, as China is still highly dependent on foreign oil, with a reliance proportion rate of 72%. This means that China's energy imports are highly vulnerable. China surpassed the United States in annual crude oil imports in 2017. These are imports. This is not production or use. This is how much is brought in from external markets, becoming the world's largest net oil importer. Hey guys, I'd love to hear what you thought about some of the updates we covered in today's episode, so throw your comments below. Always love hearing from you. Thank you for watching. I'll see you next time.